At first glance, this chart might look crazy, but don't worry, today we'll be explaining the huge divergence between the international liquidity out there and the stock markets. Hello, ladies and gentlemen, and welcome back to the Daily Show where we talk about stocks, commodities, and cryptos. We'll be deep diving into the FOMC event this week where the Fed is expected to raise 25 basis points. We'll be talking about Apple earnings. And of course, we'll also be looking at whether these charts are about to break out massively and move towards our extreme zone number 2. But more importantly, we need to talk about the S&P 500 performance versus the rest of the world, because spaces like Asia and emerging markets are starting to look very bad in comparison. What does this mean? Let's take a look at all the data and the stats going back well over 50 years. Well, welcome back everybody to the Daily Show where we talk about markets around the world. If it's your first time here, welcome to the community. Subscribe and smash that like button if you find value in today's video, which I'm sure you will. We've got a lot to cover. I'd firstly like to address, though, one of the elephants in the room. Now, obviously, we were talking about markets throughout the last week, and we've kind of had a bearish tinge around this zone. As of Friday, things kind of started to look like there might be one last push in this market to trap liquidity. And I want to discuss that concept very much. On the show moving forward, there's a few bits of feedback that I think the comment section has really made me realize that I think would be good here for the community. And I'd like to see whether you agree with this. First up, I think it's going to be good to have a medium, long-term, and short-term plan on several markets around the world. This will help us to really delineate between the data that we're seeing and the reality of what we believe is going to happen, and of course, what the markets are actually doing, which can sometimes defy this data. Remember the old saying that markets can stay irrational longer than you can remain solvent. I'd also like to remind everybody that if you haven't already followed us over on Twitter, consider doing so. I'm posting a whole bunch of special charts over there, links in the description down below. And of course, we've also got our weekly expected options ranges that have been posted. 68% of the time, markets will stay within these boundaries, so they're always great to have on your chart along with other confluence techniques. Let's talk about fear and greed index. We've gone from moving from greed, which is about 70, all the way down to neutral and then back into greed. So does this mean that we need to be cautious? Well, I think on the surface it may be. And a lot of it comes back to this idea of central bank liquidity. So the upside here could be nimble and fast, but I doubt very much, in terms of my medium opinion here, that markets are going to go very, very bullish. And what I mean by that is we might have 4, 5, 6% even upside, but I doubt that they're going to make new highs before we see something a little bit more nasty. So let me explain that. And we'll go back to this chart here that we showed at the start of the video. This purple line here, basically what it is doing is it's tracking the worldwide liquidity. It's not only just the Fed, it's also a bunch of central banks. And I've brought up similar charts like this on the channel, but I want to just explain that what often occurs is we see injections and we see taperings. And what you might notice that over the last kind of 9 months in the markets have kind of tapered, then injected, then tapered, then injected, depending on the central banks around the world. So it's kind of like artificially holding markets around this 4,000 price. And whenever it goes too much to the upside or too much to the downside, effectively markets are getting new injections in them. In essence, it's creating the kangaroo market that we see. And this brings up a few concepts, especially around forward PE, that I thought might be interesting to discuss today. But let's look at the surface of what's happening right now. These red zones here are basically showing us a strengthening divergence between central bank liquidity providing the kind of resource of the markets actually going up and the markets themselves. So they're starting to disconnect from the reality that we find ourselves in. Now, we've seen this before, and of course, disconnection can go on for a while. Here's a disconnection, here's disconnection. And it's one of the many ways that I figure out that markets are probably going overpriced. The problem is always, though, timing. So as we know, timing is everything. If a market breaks out from this level, could it go here and then dump off? Absolutely. I believe that a lot of this has to do with sucking in as much as possible liquidity. So what we saw over the last couple of days, which was a high, low, higher high, and a lower low, this will have triggered a lot of shorts. Now, personally, I like shorting in ranges like this. And the way I would do it would usually be using spreads and going for a little bit longer period. And the reason why I would go with the longer period time frame is got to do with swing. When we think about swing trading or anything like that, we really need to just consider if we're using a tool like this, it can take some time, as we've seen before, to play out. Now, eventually, did the market goes down? Yes, but you need to have the time on your side. So we'll go into whether you should have shorted this level, whether it was possible to short it with a scalping method, and all of that a little bit later on today's video. The other thing I want to talk about was the more this goes up now, and the more this goes down, the stronger and the more likely that this market is actually going to collapse. And especially if it takes out this extreme zone higher high over here, it's very likely that will trap liquidity. And when markets trap liquidity, if we think about Wyckoff and the way that he designed kind of the market, or he talked about the market, he said that the composite man, that was all of the kind of participants in the market, were looking at creating, of course, volatility. Therefore, they were creating liquidity. And they were basically creating the liquidity traps that allowed themselves to get their orders set. At this current market condition, without taking out these highs or these highs here, have we really trapped liquidity yet? Possibly no. And that's why sometimes it's incredibly hard to figure out when markets are about to switch. And instead, you might have to use tools such as options to figure out those levels. I hope that makes sense, but let's go through some of the big data here and then we'll get back into the charts later on. I will update this all the time on the channel, so this is a great way of viewing it, and this will really help us, I believe, navigate the next 1 to 2 years. So if you enjoy this stuff, remember to subscribe, smash that like button. It really does help us out and helps us to grow this community and create shows like this. Let me know what you think of that in the comments down below. So let's now take a look at some correlations here and some big data that's been going back well over a decade to do with the Asia Pacific region. Now, you'll notice this oscillator goes between kind of high numbers and low numbers. And when we're in that low number range, it's very, very bad in comparison to the S&P 500 returns. In fact, only 11% of the time do we find ourselves here. And I believe this is showing us demand destruction in force. And in fact, it's showing up in the commodities market and of course copper that we've been watching here on the channel. Negative 15.8% is the annualized return when we get readings like this out of the Asia Pacific region. Have a look at some of these stats. 2 months later after a reading like this, only 36% of the time is a market bullish. That's not a great stat when you consider that markets are generally bullish across the board. We also need to look at these commodity trends. So we've seen commodity trends starting to really look poor. We've obviously got things like copper that's been declining recently. And when we get readings like this, here is what happens to the commodities trends. We don't have too many readings, but these go back into the 1960s. And you can see that a lot of the time when we get readings like this, markets actually kind of nosedive off from the commodities aspect. Only 46% of the time are markets bullish after 3 months. So generally speaking, it's kind of like a warning sign across the commodities space. But it's not just in commodities. It is also in other markets. Here's just another read here for commodities, 15.8% negative here. When we get readings like this, only 11% of the time do we get it. Now, it seems almost the exact same reading, if you think about it, as what happens with the Asia Pacific region. I think that's because we produce, or there's so much production of goods that happen in that area that it goes hand in hand. Let's take a look here, though, in terms of agricultural commodities. Are they faring any better? This was everybody wanted to be in this during 2020 and 2021. Well, they've just made a 9-month low. They've broken through. Again, it's showing probably inflation is starting to disappear a little bit. And take a look at some of these reads. Even worse for agriculture. Only 29% of the time markets are up over the next 6 months. So what does this mean for us as investors, as for traders or anything? Well, I think it's just in line with a lot of the things that I'm talking about from the kind of longer term perspective. If you're in, well, more the medium term, and I'm going to dictate medium term is anywhere from 3 months to 12-month period. I still remain bearish on the markets over that period of time. And my explanation just basically has to do with I don't want to fight the central banks of the world and what they're trying to achieve. Now, it's all about recognizing risk versus reward. So trading, you could still be going long right now and not necessarily care because you'd be on the shorter term timeframes. And this is where I'll create a spreadsheet moving forward, and I'll actually have it on this channel, so make sure to subscribe for it, where we'll talk about our medium, our long, and of course, our short term. Now, if you're asking me what I think in 10 years, well, of course, I'd say the markets are up and I wouldn't be worried about it at all. I still love Microsoft. I still think AI is the future. All of these things still remain. But that doesn't change that I think things are a little bit overpriced. And I like to buy good price. I think you want cheap price. I want cheap price. We all like good deals. Is it a good deal in the market right now? Well, S&P 500 forward PE has been basically hovering between this kind of 17 to 19 read. This is not expensive, nor is it cheap. It's certainly on the slightly not good deal. Like, it's like you wouldn't really want to buy it, but you certainly wouldn't be going, oh, it's the worst price ever. Now, when these types of PE ratios come into the low 15s or even 12s or 13s, that's when I start getting very excited. And of course, if that combos with that liquidity we were talking about before, well, that's a great 1-2 punch combo, especially if you add technical analysis on top of it, which is what we do here on the channel. So we want to break it down that kind of way. And I think it comes pretty clear. I showed you here Microsoft, and I kind of just talked about the PE ratio being back to where it was. It's not like growth is out of control. It's certainly not where it was during 2020. It's stabilized, but it is not a cheap stock. It is expensive. So is Apple. PE ratios are not great. This isn't forward PEs, but this is PEs. They're not exceptional, and EPS is not that great. So is the risk reward worth it? Well, again, it comes down to your time horizon and what you're trying to achieve. If you're a scalper or day trader, well, you're not going to care at all. I also think that this is one other aspect of the markets, which I just wanted to be talking about from that medium term, again, that next 3 to 12 months. And I think that we should be really following money markets. Money markets are pretty smart, and we're still seeing those rising. And people are going into, there's certain money markets that are incredibly good. Some people are buying senior kind of bonds in, I don't know, let's say Australian banks or something like that, top tier grade senior banks. Some of those senior banks, we've almost found out that they've been backed by the government. So when you think about it, no wonder people are liking those. You're getting 6-7%. Wow, it's pretty incredible. However, while this is still triggering, we can't be sure that we've seen bottomings of markets because they tend to lead into the recession where everyone jumps into these types of bonds. Things go bad. Then, of course, we see the switch, and around those switch times, well, it's usually a pretty good indicator that things are turning. We also know that the Fed has most likely brought forward the impacts of all of their rate hikes with their tighter credit conditions due to the Silicon Valley Bank breaking crisis and all the other things that are going on in the banks right now. And if they do end up raising another 25 basis points, this will just exacerbate this current problem. So we know that that's most likely leading through, and we are basically somewhere in here right now of where the Fed sits. So I think nothing has changed in that aspect, and I just want to bring that to our attention. Let's now move over to the next thing, though, that I really want to talk everybody about, which is earnings. Of course, we've got a lot of earnings this week. We've got some big names such as AMD, we've got Apple, and we know that there's going to be some volatility there. AMD in particular is probably one of the big interesting ones, almost 8% expected volatility from the markets. Why I love this chart here from Earnings Watcher. I think it's awesome because it takes all of the implied moves based on the options market, and they were pretty damn spot on last week, weren't they? We got some massive moves coming out of Meta, some massive moves coming out of some of the big tech stocks, including Amazon. After hours was all the way up at 120 and then just blew all the way back down and lost 4%. We'll talk about that later. And then, of course, we've got Apple, which is sitting around a 4% expected move. So all of these things, are coming out this week. Let's now look underneath the hood of the market. So over the last couple of days, what's happened? Well, markets haven't really been going super defensive. We saw utilities drop. We saw healthcare drop. Initially, what had happened is we went defensive. We dropped for 2 days, almost lost 2 to 3% on the markets. And then we recovered it all. And you can see here that the two main kind of markets were bringing it through, technology and communications after the earnings. So it could still be a trap, and we'll talk about that later on. But let's have a look at the last 24 hours. This is the Friday trade. Again, no defensives leading the charge. Usually means that the market rally could be real. And again, it's only one of the pictures of the puzzle. So we'll take a look at all of these on the charts in just a few moments. So just before we jump into the charts and we take a look at all of the key levels we should be watching right now, I'd like to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, if you've been watching the channel for a little while, you'd know that Microsoft is my favorite stock. So we've teamed up with Tiger Brokers to offer an additional Microsoft fractional share amount for members from Australia here on the community. But don't worry, if you're from somewhere else around the world, there's a bunch of special offers down below in the description as well if you're interested in the Tiger Brokers platform. You'll get an additional US $25 worth of Microsoft fractional shares if you fund an account with as little as 1 cent, and another $30 if you fund with a $1,500 Australian amount within the first 7 days. So if you're interested in these types of things, you can definitely check them out. And up until today, if you register the 30th of April, you'd also be able to and eligible to get another 30 days free trial of ShareSite. With tax coming up, yes, in Australia, it's coming up in June. It might be the perfect time to, of course, get your ShareSite additional added extra at this stage. You can link it with your Tiger Brokers platform, and it's a new thing they've brought up. I'd also like to just remind people that one of the reasons I like the Tiger Brokers platform has to do with rotation and, of course, the economic calendar, which we're in right now. With Apple coming out this week, it's sure to be a huge event. And, of course, we've got the FOMC. But more importantly, rotation. If you were thinking of shorts recently, we've been talking a lot about copper, aluminum, and other metals have been doing kind of poorly in comparison to the rest of the market, which obviously has risen. Thanks so much. If you're interested, check them out today. All right, well, let's jump into the charts, and I hope you're sticking with us because this is going to be a pretty big point here. Let's talk about some of the top kind of biggest points of the markets right now. First up, we're bringing in here the equal weighted ETF of the S&P 500, the RSP. This really kind of gets rid of the noise of the tech sector. And if we make new higher highs here, well, of course, we have to believe the markets will move to the next levels of equilibrium. This has been one of our major problems recently with this market. It's been breadth. You can see it here. Not as many stocks are recovering and making these new highs. And that, along with that liquidity, is probably going, well, I think it will become a problem moving forward unless we see a huge breadth switch in the markets, which we just haven't seen yet. Consumer discretionary versus staples. This is things like Tesla, Amazon, those types of stocks. They are not strengthening. That is, again, not a good sign for the American consumer right now. So it makes us pause and say, wait a second, the upside here looks kind of bad. We've got bad breadth and we've got damn bad looking consumer discretionary versus staples. I don't like the debt that's on credit cards right now. I don't think anybody that even has that debt realizes how much they're going to be paying very soon. And yeah, it's not that great. Here's the chart of the Russell 3000. We've used this many times. This basically just shows us 98% of the markets. So we know that if we have 98% of the markets looking at it from the perspective of less stocks are going up as it's going to the new all-time new highs here, that's not usually, again, a great sign. So that's all these long-term ones. The VIX is dropping off, showing us that, of course, greed is in control. And all of these things are sure, they look bearish on the surface, and they probably are, but timing will be everything. So we'll keep going through this. Watch copper. This is going to be one of our big points. I really want to see copper weaken through 3.82. That may be a catalyst towards showing us the bears are in control. However, my stipulation here is going to be taking this red box out. 3.7 is where I believe everything changes here in the market dynamics. We've effectively got highs and lows and higher highs. We knew up here in January things were looking shaky. Since that point, basically markets have been doing this. And super annoying. And then, of course, we're looking towards that further weakness that's going to be shown usually in metals first. Metals and demand destruction comes through. Usually oil, copper, those two have been declining recently, and we've been seeing it. High yield bonds, they're going up with the market. That's not a bad sign. I mean, obviously here you've got what we call an ascending triangle. So if you wanted to look at that series of higher lows, and these higher lows are kind of leading into this 61.8 again. I actually, contrary to people's belief, ascending triangles, I don't really find them to be super bullish type of indicator. I'm sure you've seen this a few times. Let me know in the comments down below. A lot of the time it actually break down and go bad. I like to trade them either way, but specifically if they actually go up, then they break down. That actually is a stronger indicator to me that things went bad. But yes, HYG, we're looking here for junk bonds to drop while the stock market holds or goes up. If that occurs, along with our central bank liquidity concepts, I would be very cautious on markets, at least in my personal opinion. US 10-year continues to drop here, just showing us that kind of the world is starting to look a little bit shaky and that they expect the Federal Reserve to come in and support them. This has been the growing trend, and this is where I think the fight between the markets will be. It'll be between yields. Basically, the Fed is saying, well, we'll find out exactly what they're saying very soon, this week probably in the FOMC, but the Fed is basically telling us that they're going to keep rates higher for longer, and the market's saying, no, you're going to cut them because we need support and we know the economy is in bad shape. Well, this is where, will central banks hold firm, or will they just, kind of give up on it straight away? Let's have a look at the dollar. This is a very tough trade. We knew the dollar would, we had a suspicion the dollar would break out. I thought it might go to 102.21. It didn't quite get there, and you can see it instantly rejected back down. It's within a range, and as long as it kind of holds above this area here, and it must hold above this, I'm thinking that it's very, very clear, well, it's at least semi-clear that the markets are trying to hold this level. Do I like anything? Not really. The weekly is kind of bad. Long leg doji, you can see here, the open, the high, the low, the open, and the close. It just shows that it's at what it would consider at the moment fair value with the current information. And I believe it's waiting for the FOMC to really wait and see what it needs to do. And gold is doing something similarly. I don't like gold here. I've talked about that a lot. Partially because of commodities and other things. I am a huge fan of gold. I think gold, if we're talking long term, so that's the next multiple years, I think it's going to $3,000. However, timing is everything. So, we've been very on gold this year. It's probably been one of the best trades we've had. However, here we've got two long leg doji. That's that low high equilibrium across the point. You've got this kind of trend line sitting behind it. It keeps making lower highs. It keeps trading off this heavily traded zone towards the shorts. And unless it's able to actually breach through 2015 and close above it, which is up here, I don't really think this is long. In fact, I just think it's kind of potentially building more short positions. So be very careful here in gold. I don't like this trend line anymore. I've mentioned that several times here. And at this stage, I think even the money flow is starting to look a little bit negative. And I'll show you that in the next video, so make sure to subscribe. We've just got so much stuff to cover this week, so we'll cover that on our Monday after the close video, along with the current money flows into the stock market themselves, because they're still neutralizing, and basically we'll talk about that later on, because that's very important. What are these big money managers actually doing? What they say and what they do, totally different things. And it looks like at this stage, they're hedging their bets. They're going a bit bullish and they're holding a bit back and sitting in cash-like assets because they're scared of, I believe, equity risk premium. Let's talk about natural gas. Natural gas did go to a new high. I'm still bullish on natural gas at these levels. I think it's hopefully in a accumulation. However, I don't really know if I want it with this higher high. Probably don't really want it back below into this level. I'd like to just see it find buyers straight away. If it does go down here, I'd then expect it to rally, but then there's a problem. So natural gas kind of like holding around a zone. For now, look, it's been nice that it held that 2.1. That's where we got really bullish. Probably don't like it as a trade at these levels yet. We'll watch and see. Let's talk about oil though. Oil now, that's a little bit better. So oil made this kind of, some people think it was a head and shoulders pattern. It then broke down and then it actually rallied forward. And there's a couple of great trades here. There's an exceptionally good trade that's in our advanced scalping masterclass. Nice work. If you got that, pretty cool. However, I actually like this zone here. So it's got some confluence techniques. We've got a fib. We've got a pretty heavily traded zone. We have a supply. Certainly a zone I would be watching through the next session to see whether there's an interaction here. Remember, we have to have patience and react. And this will make sense when we look at the SPY a little bit later on and the key level and the way that you could take positions based on that level being reached. So US oil, yeah, I think it's coming into a zone that I think day traders and scalpers will be interested in. If oil is able to regain above this level, let's say above 79.61, I'd say at that point it probably pulls back a little bit and then possibly starts moving even further bullish. But it just doesn't look like it's super bullish at this stage. It's mostly bearish. And you can see here that oil has been rejecting and going down after that false break over here. Let's move over to Tesla. Now, Tesla hasn't gone above 166. However, it did find a couple of nice days of bullish trend. I've been pretty negative on Tesla. I think I remain negative. This gap fill could be going in. So if we get above here, probably be looking at drops being met by buy demand. That's a fairly decent little kind of day trade level. So we'll be looking at that one. I will update the expected moves to the options market and Tesla a little bit later on. I couldn't do it today, unfortunately. But yeah, this is a key level. I still think that we get that gap closed eventually, 145. I'm not bullish on the stock at the moment. I don't really see much reason to be so if we're going into demand destruction, which commodities suggest we are. So Tesla, yeah, unfortunately, I'm not bullish on that stock at this point. Let's move over to Apple. That's a pretty decent close. It actually got above again, and it's broken the trend line on the weekly. I mean, you can't deny it. Look at that. That's the trend line that stopped Apple every single time. It had that shooting star. It snapped it off, and it kind of looks like in earnings it wants to go up here. So I think the interaction is going to be somewhere below, kind of around this expected weekly options high and this zone over here. You'll notice I've stacked quite a lot of things on that level. This is really where the bears need to take control. If they're not going to, then what? Apple's going to make new all-time highs? I don't think so, but it's interesting. It's all coming up in the week of the FOMC. Everything looks like it's breaking out. Everything looks like so great and everything like that. But I'm not convinced. And yes, the market itself has broken. If you were thinking about bullish, I mean, as it comes back, you'd have to think that at this stage, it's going to be met by more of those buy to the dip kind of pairs. If it instantly reverses here, then you would know at that point, okay, well, it was a false break and yeah, liquidity is being grabbed, and then you just need to assess and change your style. But on the surface of it, the weekly is pretty good, and Apple looks like it's moving towards that red box. Let's look at Amazon. A totally different story. The American consumer remains horrible. Like, look at this. It's still so sick. And initially it was like, yeah, it's all good. Goes up to this level here, and then just dumps straight back down into this zone. And it was down 4%. It really shows you how bad the situation is potentially when you've got stocks that was once seen as supreme, like Amazon, turning. And it shows you again the demand destruction and the difference between stocks. So that's where I think Apple's really interesting, because you would expect Apple to see a decreased demand on a lot of its services and products, but the stock just doesn't want to do it. It's often seen as a bit of a trapper for retail, and we've used it several times in 2022 to find those levels. So we'll be watching it very closely throughout this earnings week. I'll be updating you as much as I can. NASDAQ versus SPX. This is just a bit of a ratio trade that you can see. A great big trend. The trend was broken. Then it's been, and look where it is. It's retesting. So again, is the NASDAQ going to continue to outweigh the SPX? I would guess based on valuations, the NASDAQ is overpriced in comparison. However, again, timing is everything. So we'll keep talking about that until we see the big switches occur. DAX here, new high, pretty interesting. Decent breakout. Is it going to hold it? Is this some kind of Wyckoff trap? Big level for it. It didn't quite close weekly any higher than I expected. So some people could see this as a UT or a UTAD breakout from a Wyckoff. You won't know that until you see that lower high switch. So at this point, we don't have any extra information. On the surface of it, it looks bullish. If I was believing it was bullish, where would the next level be? Well, it would have to be around 16,300. So you'd be thinking at that level. I don't think the risk reward's worth it, but day traders will be watching that. And generally what you'd be doing is you'd actually go into the smaller timeframes and you'd say, okay, well, if this drops somewhere in this range, and I haven't done it, but somewhere in this range, you're getting at that kind of bullish pickup, and then you look for it to just basically explode back up. Let's move over to IWM. So this is one that is the small caps or the kind of regional banks and the general lifeblood of the American economy. It just is nowhere near as strong as the other markets. And we were looking for a daily to go really, really bad. It didn't quite close below the key levels. So you can see that on the Russell 2000 here. And what people are looking for, and what I am looking for, is the closure underneath, well, specifically 1700, but at the moment, actually something around that 1720. So if it closes below 1720, I think that the markets have made a decision that things are sick, and often the Russell leads. So if the Russell 2000 is getting horrifically shorted, then the rest of the big stocks often turn after that. And that's why we use it as a bit of a lead indicator. I put in a bracket here, short zone. I do think it's a fairly stacked level. So that would probably ensue only if we got further bullish market action. We come into a fairly stacked zone, equilibrium levels, supply. Yeah, many, many reasons why I don't like that zone very much. So again, would day traders be here? Yeah, they said they could potentially be around that zone. Of course, you could apply your own systems and have a look yourself if that did occur. Qs, I mean, on the surface, again, so tight. Did we get a new high closure breakout? And I always say the close is the key. No, we didn't. Does it look bullish? Oh, on the surface, yeah. I mean, there's a few things that do. The first one has to be this. So obviously we get a gap down, we build a position, we take these stop losses here, which we expected for then it to rally. That's fine. But then it rallies and it kind of creates a bit of an island reversal. Now, it does that off a build of a position. So if this thing explodes out, you have to kind of think that the pullbacks at that point should be met by buy demand. If it then did this, okay, that's a false break. Again, this is all down to minutia here. We have to be very on it. This is going to be super tight. We know liquidity is bad. So we have to think about it from a perspective of there could be a serious bear position here, but it's only going to be a serious bear position if we get the right traps of the liquidity. And we just don't know that. At this stage, you go, wow, that thing looks pretty bullish. I mean, here's the closure, and you can see the Qs actually close out. They fill the gap, they go higher. It looks pretty damn strong. So yeah, it's a very, very tight position here on the Qs. And at this stage, you'd have to think that's a breakout to the long side, but it does have a gap fill in it. Next stop, 329, kind of this level up here with the expected weekly options highs. So again, pullbacks should be met by buy demand, at least on the Qs themselves. Let's have a look over here at the US 100. Again, you can see that we thought this might be a little bit of a stop loss hunt. It sold initially, and then it just rallied straight back up, closing right on the highs, not giving us enough evidence. It's super frustrating when you don't get this evidence, but that's how markets would look. Weekly has broken out. Daily has theoretically broken out here as well. So again, both look bullish. Both look like pullbacks met by buy demand, probably moving forward. If they are to be false breaks, we should know about it very soon. That's going to come into the FOMC. And this comes down to picking the correct instrument. If you were someone that shorted, let's say, through this zone here with the SPY, how did you short? Did you do it with options puts? Did you do it with options with time? Did you do it with a CFD or a futures contract or an ETF? All of these things will become important because most people are going to have their stop losses here and here. And this position is probably a swing position. We've been waiting for that switch for a while. When that switch occurs, I would say actually about 70% of the time, the market should short this zone. So with it's pretty common they would do it. And you have to then decide, okay, well, how are you going to take that position? If you take it with an option with 2 months, you're probably going to be okay. Even if the market goes like this, there's a good chance it will come back later on due to what we see right now, which is the central bank liquidity going so bad. So, of course, that's going to be a big one. Let's have a look at the SPX here. Again, in that critical zone, you can see the closure, super frustrating. And let's go over here to the weekly. So I've said between basically a close above 4180 on the daily would be a big deal. We didn't get it. We got 4171. We went down low. We made a lower low. We filled a bunch of gaps. There's still tons of gaps on the downside. So we've got 2 here. We've got 1 left here now. We've got the most traded zone, which is where we ended. We started the market on the Friday, and it went short initially and then just rallied straight through it. Again, making it look like the bulls are in control. From the weekly perspective, they did get a new close high. If you believe in weekly close, that's a fairly bullish signal. If we go here to the daily, new daily high. So again, that's pretty strong. However, it's not above 4180 yet, which again is kind of making you think, well, possibly it could still turn. And that's why sometimes it's better to be neutral and just to look at it and say, well, do I really want to get involved? If it goes up like this, then comes down, hits the heavily traded zone, does something like that, well, yeah, I want to get involved because at that point, statistics are on your side and your business plan would be very, very good. So it's all about selection at those periods of time when it occurs. Let's have a look at the 10-minute chart just to understand what actually occurred on the Friday market. So we can see here we had kind of like a little rally. Then we sold off. We rallied back up a little bit here. And then we just kind of dumped. We did move from that level, but we didn't quite get the switch that I would have liked to have seen. My ideal switch would have been actually what it did, which is this. Movement back down, underneath there, heavy short. That's what I would have done if I was able to trade it. Obviously, it was through the night. I am an Australian. It was pretty hard. But yeah, that's kind of the zone that you definitely want to look at. Now, because we know this is a heavily traded zone, if markets do retest back down to that, you've got to believe buyers are probably sitting in that level. And if it then goes through this level, well, then, of course, you can believe sellers are back. So it's going to be very, very interesting navigating this zone. But it doesn't change my overall factor here that I still think the markets will be negative over the medium term, 3 to 12 months. And I will continue to update my thought processes here. And of course, the next level, should we get through this, 42.17 and 43 kind of 100 to 43.50. Up here, there are so many fund managers waiting. If that occurs and we get above here, you better believe this is going to be where liquidity steals are real. Look, if it happens, you almost celebrate that day. That is going to be a huge level. So remember to keep those types of points on your chart. If this does occur, then you've got to be watching it. So we'll be on top of all of that this week and more. I want to just point out as well, unfortunately, still there are so many puts in this market, making it hard to go down. 400 puts all over May, 400 and 390 puts all over June as well. So still quite a lot of pretty nasty puts, 2.34 million contracts. So still quite a lot open, but you can see here 166,000 puts sitting at 400. So that's why the markets are having such a tough time going down so much. What about Bitcoin? What's going on there? Bitcoin's just chilling. It's just in the middle of nowhere land. It could be going towards the short or the long. We've been on top of Bitcoin very strongly recently. It's been excellent trading, but I think it's kind of doing that. Now, a pennant, theoretically, if it breaches out, would be a bullish signal going to new highs. I've said watch reaction here because I do think there's a bit of a defended zone around this area where I think bears could come back in. So be careful around that level. But I don't really have an opinion on Bitcoin just yet. I'd like to see some breakouts, some further moves. We were super bearish feeling here. We felt a bit more bullish through this box in here. And now we find ourselves in what I'd call the neutral zone. So very, very tough to figure out the next direction here for Bitcoin just yet. But we should know throughout this week. Now, do remember this week is filled with information. So we have FOMC press conference here on Wednesday, May the 3rd. This is all New York times. So we've got the first non-farm employment changes, a huge week. We've got ISM services PMI at 10 a.m. Then we've got the FOMC statement and funds rate decision expected to be 5.25%, up 25 basis points at 2 p.m. and 2:30 p.m. New York time. And then we scroll down and you can see unemployment claims, a whole bunch of other central banks, and then the big one as well, non-farm employment change on Friday. So a lot of stocks and markets, things like the US dollar, things like gold, they can often sit there sidewaysing into these events, especially the non-farms event as well. So you've got to be super careful this week. A lot of range, a lot of tight stuff, a lot of neutrality. It's a very interesting time, and I hope you do follow the channel and we can go through it together and, of course, understand it better. Thanks so much for watching. If you enjoyed today's video, please subscribe, smash that like button, follow us on the other social media platforms, links in the description down below. You can also get 3 free trading cheat sheets. I've got a couple of extra ones coming up. And do remember as well, the sponsor of today's video is Tiger Brokers. Big thank you to them for supporting the community. And obviously, if you're interested in signing up with them, there's a bunch of special offers down there. Thanks so much. You have a great weekend, and we'll see you for a big week this week coming. I'm excited, and I hope you are too. Bye for now.